Guten Tag, liebe Zuschauerinnen und Zuschauer, und herzlich willkommen in unserem Energiestudio zu unserem heutigen Webinar, in dem wir einen Blick auf die globalen Gasmärkte in diesem Winter werfen. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation bei die Gas- und Wasserstoffwirtschaft. Ein Blick auf das Thermometer, auf die vereisten Straßen und verschneiten Landschaften zeigt es deutlich, wir befinden uns mitten in der Heizsaison. Als Energieträger für Heizungen spielt Erdgas in den meisten deutschen und auch vielen europäischen Haushalten nach wie vor eine zentrale Rolle. Das vergangene Jahr 2025 war für die globalen Gasmärkte ein Übergangsjahr. Geprägt wurde es von der Entscheidung der EU, ab 2027 kein Gas mehr aus Russland zu beziehen, sowie in Deutschland von einer anhaltenden konjunkturellen Schwäche. Zugleich gewinnt der globale LNG-Markt weiter an Dynamik, wie wir bereits in unserem letzten Webinar zum Gas Market Report festgestellt haben. Mit Beginn des Jahres und der fortschreitenden Heizsaison leeren sich die Gasspeicher in Deutschland und Europa. Ein guter Zeitpunkt also für uns, um erneut einen Blick auf die globalen Gasmärkte und den aktuellen IEA Gas Market Report zu werfen. Und dazu begrüße ich heute wieder Gergely Mollner, Gasanalyst bei der International Energy Agency, und Frederick Ritter, Energy Analyst ebenfalls bei der IEA. Als Autoren des Gas Market Reports haben Sie sich intensiv mit der Entwicklung der weltweiten Gasmärkte beschäftigt und wir freuen uns sehr auf Ihre Einschätzungen. Wir veranstalten das Ganze als Zoom-Konferenz, die aufgezeichnet wird. Wenn Sie nach den Vorträgen Fragen haben, dann nutzen Sie gerne die Handhebelfunktion oder die Chat-Funktion. Die Veranstaltung wird aufgezeichnet und ist im Nachgang abrufbar. Now I will switch to English. Welcome again, Gergely and Frederick. We are very glad to have you with us. With the heating season well underway, it's a perfect opportunity to take a closer look at the recent IEA Gas Market Report, which was published last Friday. We are especially excited to gain further insights into the likely continuing and growing role of LNG in the global market. And so, Gergely, the floor is yours.
Thank you, Charlie, for your kind words of introduction. It is a great pleasure to be back to our traditional webinar. I'm very happy to join the meeting together with my colleague Frederick Ritter. As you mentioned, we did publish just last Friday our latest quarterly gas report, which is available on our website, iea.org. And the report provides a look back to 2025 on the key developments and also a short-term outlook for 2026. And today's presentation will be very much structured around the report. So first we will give our assessment of the 2025 developments. Then we will move to our short-term outlook, which will also provide a special focus on the Asian market. And then we will, in the last part of the presentation, we will also share our views on the European gas market developments. So I think, of course, one way to take the pulse of the market is to look at the prices. And this chart shows the evolution of Asian spot LNG and European hub prices since the beginning of 2024. The dark blue line is TTF, the European benchmark. The light blue line indicates JKM, a key marker for Northeast Asia, and the gray area between the two is the spread. And when looking at 2025, we really consider this year as a transitionary year for natural gas markets, with prices facing very different pressures over the first half and the second half of 2025. In the first half of the year, both TTF and JKM were trading well above their 2024 levels. TTF was up by almost 40%, and JKM was trading 30% above its 2024 levels. And we believe that this has been very much driven by the tighter supply fundamentals, but also geopolitical tensions such as the Middle East crisis provided upward volatility on prices. Now, the market started to ease in the second half of 2025. We see this in the trend lines just above the bar. And both TTF and JKM closed 2025 standing 35% below their December 2024 levels. And as we will discuss this in a minute, that has been very much linked to the strong growth in global LNG supply. And if we look at the very right hand of the chart, we see that 2026 opened with a quite explosive volatility, with a very wild bull run, actually the strongest since the 2022-23 gas crisis. That has been very much driven by the rapidly shifting physical fundamentals, but also the repositioning of financial players contributed to that strong upward swing. We will discuss this later in the presentation when looking more closely to the European developments. Now, despite all this strong volatility, it is also notable that the correlation between TTF and JKM rose to an all-time high in 2025, standing at above 0.95. Now, this compares to a correlation factor of just 0.15 back in 2015 and reflects the growing interconnectivity and interdependence of regional gas markets. It really highlights the globalization of regional gas markets, and it is closely linked to the rapid scale up of flexible US LNG, which now accounts for over 1/4 of global LNG trade. But it also reflects the increasing share of spot LNG trading and the rising role of portfolio players, all of which contribute to the growing flexibility and liquidity of the global LNG market. Now, this chart gives us an overview of how global gas trade has been evolving. It includes the key piped gas trade channels as well as global LNG supply. And I think what is quite visible here is that after the 2022-23 supply shock, markets moved towards a gradual rebalancing, and this in a way continued also in 2025. As mentioned, we have already seen a rather strong increase in LNG supply in the first half of 2025, but that has been largely offset by the declined piped gas supplies to Europe, including from Russia. When we are looking at 2025, our estimates indicate that global LNG supply increased by almost 7%, but 75% of that growth has been actually concentrated in the second half of the year, when global LNG supply increased by around 10% year on year. And this has been very much supported by the strong increase in LNG production in North America. And of course, both the US and Canada contributed to that increase. And as we have seen previously, this strong increase in LNG supply contributed to the easing of market fundamentals over the second half of 2025. When looking at the demand side, we see a clear slowdown in 2025. After the strong increase of 2.8% in 2024, we estimate that global gas demand increased by less than 1% in 2025, and most of that growth has been actually concentrated in North America, Europe, and the Middle East. In contrast, when looking at Asia, here gas demand remained broadly flat, partly due to weaker industrial activity, but also the relatively high spot LNG prices weighed also on gas demand in the Asian markets in 2025. In Eurasia, natural gas use declined by an estimated 2%, partly because of the milder winter weather conditions in Russia. Central and South America is a bit of a mixed bag. We have seen a very strong increase in Brazil, driven by stronger gas use in the power sector, but this strong growth has been almost entirely offset by the declines recorded in the other markets of the region. In North America, we estimate that gas demand increased by around 1%, very much driven by the stronger gas use in the residential and commercial sectors on the back of colder winter weather conditions. But this strong growth has been partly offset by gas to coal switching dynamics in the power sector. Then looking at Europe, we see a rather strong increase in gas demand of around 3%, primarily supported by the stronger gas use in the power sector amid lower renewable power generation. And last but not least, the combined gas demand of Africa and the Middle East increased by an estimated 2.5%, largely supported by the oil to gas switching dynamics in the power sector. Now, let us have a closer look to LNG investments. In 2025, we have seen more than 90 BCM of LNG liquefaction capacity sanctioned, which makes 2025 the second strongest LNG FID year on record. And as we can see, after the pause in 2024, the US is really leading the LNG game. More than 80 BCM of LNG liquefaction capacity was sanctioned alone in the United States, which is an all-time high for the US gas industry. And this, of course, reflects the industry's confidence in the continued growth in LNG demand, and also highlights the supportive policy and regulatory environment for gas projects in the United States under the new administration. This LNG wave is also set to reinforce the US leading position in the global LNG market. We expect that the US share in global LNG trade will increase from just around 20% back in 2024 to over 1/3 by the end of the decade. The strong momentum behind LNG FIDs also supported a booming in LNG contracting activity. More than 130 BCM of LNG contracts were signed in 2025, which is an all-time high in our records. When looking on the supply side, no big surprises here. The United States alone accounted for around half of the contracts concluded. And when looking on the buyer side, we see that the role of portfolio players remain absolutely crucial, accounting for more than half of the offtake contracts concluded in 2025, followed by Asia. But we also see more vivid LNG contracting activity coming from European buyers, with their LNG contracts more than doubling compared to 2024, and reaching 25 BCM in 2025, as Europe continues to diversify away from Russian gas. Another important development when looking back to 2025 is the growing trading volumes across the key gas regions. On this chart, we are showing how gas trading and hub liquidity evolved in the United States, Europe, and Northeast Asia. The churn rate, which is the red line here, is a key indicator of hub liquidity and tells us how many times one gas molecule has been exchanged before delivered to the end consumers. And what we see here is that gas trading in the US on Henry Hub increased by around 8%. Gas traded volumes in Europe rose by an estimated 17%, and ICE JKM derivatives rose by a very strong 35% in Northeast Asia, despite the lower spot LNG procurements by China. And we also see that the churn rates have been improving across all these markets. So this increase in trading has been really driven by a number of factors, including the growing short-term variability of gas-to-power demand, but also the growing regional interconnectivity is probably contributing to that growth. We are living in an increasingly complex gas world, which necessitates more sophisticated hedging strategies and more active trading along the forward curve. So let us now have a look to what we expect from 2026. And this slide gives us a high-level overview of the various factors which might play a role in setting the dynamics, the tone of the 2026 gas market. When looking at the supply side, and Frederick will discuss this in more detail, really the most important factor to consider is the unfolding LNG wave. We do expect that global LNG supply growth will accelerate to over 7% in 2026 and add more than 40 BCM of chilled gas to the market. When looking at the piped gas trade, we expect that Europe's piped gas imports will marginally decline, partly because of the lower piped gas deliveries from Russia. And when looking at China, we expect that piped gas imports will remain broadly stable, although we also see some downside risks coming from Central Asia, mainly because of the upstream deliverability issues faced by Uzbekistan. The demand side is a bit more uncertain, a bit more complex. One key factor to consider is, of course, EU storage requirements. When looking at the current state of European storage inventory levels, they are standing about 14 BCM below their 5-year average, and this indicates that storage injection demand could be rather strong this summer. Another important element to consider is Asian gas demand. There are macroeconomic uncertainties. There is also question marks around how strong will be the demand response of Asia to the strong increase in LNG supply. As we will discuss in a minute, we do expect that Asia will come back to the market rather strongly, but of course there are uncertainties around that. And this whole picture can be, of course, easily distorted by the forces of geopolitical tensions, and here some of them which we consider key in respect of the gas markets. Of course, Russia's ongoing invasion of Ukraine, different tension points in the Middle East, and evolving trade policies. Now, this chart gives us an overview of our expectation for global gas demand growth for 2026. After the slowdown in 2025, we do expect that global gas demand growth will accelerate to around 2% in 2026, and this translates to approximately 85 BCM in absolute terms. The first bar gives us the global picture. We see that this growth would be very much supported by the increase in gas use in the power and industrial sectors, together accounting for roughly 80% of incremental gas demand. From a regional perspective, we see that the Asia-Pacific region is expected to come back with quite some strength to the market. We expect that Asian gas consumption would increase by more than 4% and account for around half of global gas demand growth in 2026. And this is very much supported by growing demand in China, India, as well as emerging Asian markets. But as we will discuss, this is also very much driven by the assumption that the improving supply fundamentals will trigger a rather strong demand response coming from the region's markets. When looking at the Middle East and Africa, we expect that demand will increase by 3.5%, very much supported by the ongoing oil to gas switching in the power sector, but also the expanding gas-intensive industries in the region. In Eurasia, we expect gas demand to recover and to increase by 3.5%, very much driven by RESCOM and gas use in the power sector, which here also includes district heating, which is quite an important element in the Russian energy mix. In North America, we expect gas demand to stay broadly flat as the expected declines in RESCOM are largely offset by the higher gas use in the industry and the energy sector. I have also to say that this forecast will be, of course, carefully revised to incorporate the effects of Storm Fern, which is currently hitting the US market. When looking at Central and South America, we expect that natural gas demand will decline by around 1%, partly because of the improving hydro availability in the region, which would depress gas use in the power sector. And last but not least, in Europe, we expect that natural gas demand will decline by 2%, mainly because of the lower gas use in the power sector amid the continued expansion of renewables. In contrast, we do expect some recovery happening in the industrial sector and also in the residential and commercial sectors. And with that, I would like to give the floor to my colleague, Frederick.
Thanks very much, Gergely. So with this acceleration in global gas demand growth in 2026 that we saw in these previous slides, I think it's useful now to turn directly to what is ultimately the keystone of our outlook and of this acceleration this year, and that's the LNG balance, as Gergely has mentioned a couple of times now. So we're aware of this next wave of liquefaction capacity additions that is coming to the market over the rest of this decade, the second half. And looking back to 2025, it's clear that this wave has already started to deliver. And what's more, we anticipate the supply growth to accelerate in 2026. Now, supply grew by a little bit less than 40 BCM in 2025, with new liquefaction projects, notably in North America, driving this growth. These are projects like Plaquemines LNG, the Corpus Christi Stage 3 expansion, LNG Canada as well. Already that they began delivering significant upside in 2025, and they are set to continue adding volumes to the market in 2026. Now, a few downside factors did emerge in 2025 too. This is mostly from legacy exporters like Russia, Norway, Algeria, for example, which reminds us that both structural and unforeseen events can work against this general growth trend in the coming years. Although, let's be clear, we're not talking about the same order of magnitude of the downside risks and the upside in supply that we see coming to the markets. Nevertheless, in 2026, we expect over 40 BCM of incremental LNG to reach the market. This will bring LNG trade to over 600 BCM, with North America again driving this supply growth. And we expect this to carry the global market even further toward a more favorable buying conditions overall as we emerge from what was still a transitional year in 2025, as we've said. And this next slide, looking at the LNG import side, illustrates our thinking behind this transition from 2025 to 2026. Now, we're not showing the entire import side balance here, but we're focusing instead on the two most crucial moving parts, that's Europe and Asia. The chart shows year-on-year incremental LNG imports in both Europe and Asia, plus the net total LNG supply growth in any year. What we see is that in recent years, Europe and Asia have moved in opposite directions when it comes to LNG import growth. Most relevantly, we can focus on the period 2022 onward. If we recall, in 2022, Europe took in about 60% more LNG year on year to help balance its market from the sharp drop in Russian pipeline volumes. And this represented a volume far greater than the total extra supply coming to the market that year. And as a result, Europe pulled volumes away from other markets, notably Asia. Now, in the following year, Europe barely relinquished any volumes, but still decreased very small volumes of LNG. And Asia was able to return to the LNG import growth, or to LNG import growth, thanks to a bit of new supply coming onto the market. Later on in 2024, it was Asia's turn to take in more LNG as the European balance improved, thanks to a stronger storage position, better pipeline import flows, for example, before again having this situation completely flipped in 2025 with a tighter European balance, leading to more volumes being pulled away from Asia as Europe imported this record amount of LNG. So in these relatively tight market conditions over these past few years, what we see is that growth in one region implied a reduction in LNG imports in the other region. This was essentially the competition between the two most important LNG importing pools in the market. But what we see is 2026 playing out in a different way, with incremental LNG supply in the market, allowing both regions to increase their LNG imports simultaneously. This would be a first since 2019, which remains the record-holding LNG supply growth year. Now, this is a sign of the general state toward which we see the market moving this year. But let's take a look at these two key regions, Asia and Europe, starting with Asia in this next slide. So Asia has been the sort of primary driver of global gas demand growth in recent years, but demand growth slowed considerably in 2025, as we saw in the previous few slides. 2025 was a year where European LNG imports soared, and this gives us an indication of the underlying factors behind the slowdown in Asian gas demand growth. Relatively clement weather, winter weather notably, weaker economic fundamentals, and spot LNG prices that were higher year on year over the whole first half of the year. All these elements participated in slowing gas demand growth across the region. And we also see improving nuclear availability and growing renewable power generation playing a role here in minimizing gas demand growth. Now, China is the first country that comes into play here, of course, but the trend of low demand growth spread across the entire region, with India and other emerging markets also seeing only marginal growth. In 2026, however, we see demand growing at over 4% for the region, as all markets essentially benefit from this improving global gas balance. If we turn to the chart on the right, we see how this trickles into all sectors, and particularly the usual growth drivers of industry and power sector demand. What we expect is to see a recovery in underlying economic and industrial fundamentals that work hand in hand with this increasing LNG availability. On the next slide, we'll focus a little bit more on China here, just to better understand this motor of growth. As we saw in the previous slide, China was no exception to this demand slowdown in 2025, with industry taking the biggest hit from its usual position as the primary demand driver, of course. As we mentioned previously, we expect this to revert back to more significant growth in 2026, from about 1% last year in 25 to close to 5% this year. Now, this might seem like quite the jump, looking just at these numbers, but what these annual data don't necessarily show is the fact that the 2025 slowdown had already started in late 2024, and that the recovery that we're expecting in 2026 was already underway in the second half of 2025 for China. We're talking about a modest recovery, but we do see this accelerating into 2026. So as such, we expect demand dynamics to continue improving this year, but of course, this is also subject to Chinese economic fundamentals. China retains, the structural growth elements in its gas markets that, under the right macroeconomic conditions, the right price conditions, are definitely expected to re-emerge. But we also see that gas demand is reactive to the broader economic context. If we turn to the supply side, we see that China relied much less on LNG in 2025, with domestic production and increased pipeline imports from Russia being more than sufficient to cover what small incremental demand there was. In 2026, we do expect a return of Chinese LNG buying. However, as we see in the chart on the right, we expect Chinese LNG imports to remain below their highs of 2021 and 2024. One more thing that this chart shows is, on the chart on the right, is China's balancing role in the LNG market. We've already seen this intermittent balancing role for Asia and Europe in a couple slides earlier. But behind this is one key market on the Asian side, and that is China. So it's useful to keep this in mind. China is somewhat of that linchpin in either relinquishing volumes when it doesn't need it or when those volumes are too expensive, and then returning to the markets when those volumes are more accessible. Now, beyond China, we also have India and other emerging Asia on this next slide. Both groupings saw declining gas demand in 2025, with spot LNG prices again weighing on the market and scaling back the economics of gas in a number of sectors. We see this turning around in 2026, of course, as growing energy needs and improving LNG availability push gas demand growth of around 7% in both India and emerging Asia, this grouping. While this is expected to be split predominantly between industry and power in India, power sector gas burn is by far the largest element in the other Asia markets grouping, where power demand growth is a defining element of the broader energy context. Now, what we see is that this growth will increasingly depend on LNG imports. This is the chart on the right, showing the share of LNG in total gas demand. This is a region where legacy gas production is increasingly facing the reality of aging assets or difficulty in bringing online new fields. So while improving LNG market fundamentals are set to help these markets return to demand growth, this can also be somewhat of a constraining factor, particularly in periods of a supply crunch. Now, this is not necessarily what we're expecting over the next few years, but we should recall that most of these markets are somewhat tributary to the dynamics of the bigger markets. That's Europe, that's China, that's the mature Asian LNG importers like Japan and Korea, for example. Now, this is a snapshot of Asia, of course, but as we saw, the flip side of this LNG story that's happening in Asia is often found in Europe. So I'll turn it back to Gergely to switch regions here.
Thank you, Frederick. And let us now move back to our old continent, the European gas market. So this slide gives us a closer look to the demand side and how it evolved in 2025. So as mentioned earlier, we have seen a relatively strong growth of around 3% in Europe in 2025, which has been partly driven by colder winter conditions in the first quarter of the year, which supported higher space heating requirements in the residential and commercial sectors. But as we can see on this chart, the really big mover here was the power sector. In our estimates, gas burn in the power sector surged by more than 10% year on year. And this has been partly driven by stronger electricity consumption, but also by lower wind and hydropower generation. And this lower renewable output created additional market space captured by flexible gas-fired power plants. In contrast, gas use in industry declined by an estimated 2.5%, partly because of the relatively high spot prices in the first half of the year, which depressed gas use, especially in the more energy and gas-intensive industries, such as fertilizers. This slide gives us an overview of the evolving supply picture. So as just mentioned, we have seen stronger gas demand in Europe, but we have also seen higher storage injections in 2025. Meanwhile, Europe's piped gas imports have been declining. Deliveries from Russia to the European Union dropped by about 45% after the halt of the transit via Ukraine. But we have also seen lower piped gas deliveries from Norway due to higher maintenance, as well as lower gas flows coming from North Africa. So in this context, LNG played a key role in balancing out the European market, and we have seen LNG inflows surging by 30% or around 40 BCM in 2025. And as we can see on this chart, most of the incremental volumes have been supplied from the United States, highlighting the key role of flexible US LNG in ensuring adequate gas supplies to the European market. So LNG imports into the EU reached an all-time high of 175 BCM in 2025. Now, as mentioned earlier, 2026 opened with quite some volatility for the European market, but the same can be said about Asia and of course from about the US. When looking at TTF month-ahead prices, we saw that they surged by around 45% in the first 25 days of January. And this marks the strongest bull run for TTF since the 2022-23 prices. I have also to say that despite this very strong increase in gas prices, we are still well below the January 2025 levels. But what is driving this strong increase? I think that partly the physical fundamentals. We had colder weather conditions in January, which boosted demand in the residential and commercial sectors, but also, very importantly, lower nuclear output and in some parts of Europe, lower renewable power generation contributed to an increase in gas burn in the power sector, which increased by around 10% in the first 25 days of January. Now, this stronger gas demand contributed to higher storage draws, and as we can see on the second chart, EU inventory levels are now standing well below 50% of their working capacity, and they are standing about 14 BCM below their 5-year average levels. Now, this rapid change in the underlying market fundamentals also prompted short covering from financial players. As we can see on the last chart of this slide, the net short position of financial players were climbing to near record highs at the end of 2025, which effectively means that a lot of people were betting on the continued decline in natural gas prices. Now, this changed with the shift in the physical fundamentals and prompted short covering in order to limit further losses. And of course, this naturally exacerbated the upward swing on TTF. I think a very important development to note is the European Union's decision, which had been formally adopted earlier this week, is to fully phase out Russian gas by the end of 2027, by November 2027 at the very latest. It will be, of course, a step-by-step process with the short-term contracts being phased out already in 2026. And this, of course, would create additional market space for non-Russian LNG suppliers, we estimate that the impact in 2026 will be rather limited, although we could see a decline in Russian piped gas deliveries of around 2 to 3 BCM, mainly to the Central and Eastern European markets. Now, how will the European gas market balance out in 2026? We do expect stronger storage injections to refill underground storage sites. And these higher storage injections will offset the expected declines in domestic consumption. As mentioned, we also expect lower Russian piped gas deliveries, but also less piped gas coming from Iran to Turkey, as the long-term contract between the two countries is set to expire in the middle of the year. And I think also notably, we do expect that the rather strong piped gas exports from the European Union to Ukraine will continue in 2026, considering the damages which have been made to the Ukrainian upstream by Russia's attacks. And when we are putting together all these bits and pieces, we see a case for stronger LNG imports into Europe, climbing to an all-time high of over 185 BCM. Of course, there is naturally uncertainties around that forecast, but what we also clearly see is that LNG became a structural source of baseload supply for the European market, and it will stay that for the years to come. Dear colleagues, please allow me to conclude with a few key takeaways. When looking back to 2020, we consider it as a transitional year for natural gas markets, with prices facing very different pressures over the first and the second half of the year. And while supply fundamentals remained relatively tight in the first half of 2025, we have seen a clear acceleration of global LNG supply growth in the second half of 2025, with global LNG supply increasing by 10% and easing up market conditions. Global gas demand growth slowed in 2025 to below 1%. That compares to 2.8% growth in 2024. And this has been very much due to the relatively muted demand in Asia, where weaker industrial activity and relatively high spot LNG prices weighed on natural gas use, especially in the first half of the year. I also would like to mention that we started to see quite some recovery happening in certain markets in the last quarter of 2025, including in China. When looking at LNG FIDs, 2025 has been a very strong year, actually the second strongest gas year for the LNG industry, with more than 90 BCM of capacity sanctioned and alone more than 80 BCM reaching FID in the United States. And this naturally supported booming LNG contracting activity with more than 130 BCM of contracts signed. As mentioned, that has been very much driven on the supply side by the United States. And we also see more vivid LNG contracting activity coming from the European buyers, including companies from Germany. Now, looking ahead to 2026, we expect global LNG supply growth to accelerate to over 7%, which would be the fastest pace since 2019. And this strong growth will be very much supported by the United States, Qatar, and Canada. These improving supply fundamentals are expected to foster stronger gas demand growth, especially in the price-sensitive Asian markets, and this would drive up global gas demand growth to near 2% in 2026. When looking at Europe, we do expect that the region's natural gas demand will decline. But at the same time, we expect that LNG imports will continue to increase and will reach a new all-time high in 2026, driven by a combination of factors, including higher storage injections, lower piped gas flows, and stronger piped gas deliveries to Ukraine, which are an absolute necessity considering the very difficult energy supply security situation in Ukraine. Dear colleagues, thank you very much for your kind attention, and we are looking forward to your questions and comments.
Thank you, Frederick and Gege, for these interesting insights. And now I'd like to start with a few questions we've already received. And I also like to invite you, dear viewers, to submit further questions via the chat or by raising your hand. Let's start with today's situation. You mentioned the European storage levels. They are dropping fast. How fragile would you say is the situation in the actual first quarter of this year?
Of course, when looking at the storage levels, they are, as mentioned, 14 BCM below their 5-year average. There are certain regions in Europe, including Northwest Europe, where average storage levels are even lower than that. I think that in itself, well, this clearly indicates that there will be some homework to do during the summer. At the same time, the good news is that there is a lot of LNG coming to the market, and this, I think, provides some safety buffer. And because of that, that should not be concerns regarding the physical availability of natural gas. But I also would like to highlight that the global LNG market is a very complex one. And there could be disruptions along the value chain, which then could tighten very quickly the market. So I think it is important that the safety buffer which is provided by underground storage sites is better used in the European context.
Mm-hmm. That brings me to the next question here in the chat. What is your view on prices for 2026? Especially, let me add this when we look at the big task you mentioned to refill the storages.
Thank you for that question. So at the agency, we don't provide price forecasts. We do rely on the forward curve, but maybe we can also share a couple of comments on the underlying fundamentals. And I think that we still do expect an easing of market conditions ahead of 2026. Although I think that for the summer prices, just relatively strong storage injections in Europe will certainly provide a floor. So I think that this is really becoming a key structuring factor for the summer contracts, and as such, a key issue to watch.
Another question in the chat, does the IEA anticipate overcapacity in LNG in Europe, and what risk does it see for stranded assets at terminals with terms until 2040 or beyond?
What we have seen after Russia's invasion of Ukraine is that LNG import terminals played a key role in ensuring the region's supply security. We have also seen a fundamental shift in the role of LNG for the European market. Before the 2022-23 gas crisis, LNG was in a way the marginal molecule. Today, as mentioned during the presentation, it became a structural source of baseload supply, similar to Norwegian piped gas deliveries. In addition to that, LNG is also providing some flexibility to the European market, a very different flexibility compared to what is provided by underground storage sites. But we see that that LNG inflows to the European market are quite displaying some seasonal profile also. And as such, when we are looking at some commentaries saying that okay, the utilization rate of LNG gas terminals is sometimes low, or it is at around 50% over the year, and so on. That does about that indicates as overcapacity. I would nuance that because this unused capacity is in a way a safety buffer, which and we see periods when the utilization rates go up quite significantly. Once again, because LNG has this double role now in the European gas system, being a baseload source of supply, but also providing very important flexibility to the European gas and energy system. So I would not say that there is overcapacity, especially when looking at the more sub-regional perspectives. When we are talking about the phase out of Russian pipe gas, that will be mainly impacting Central and Eastern European markets, which are at the moment, I think, when we are looking at the LNG import capacity, which is directly or indirectly available to those markets, is still relatively tight compared to the Northwest European markets.
Thank you. And the next question, you mentioned 130 BCM per year of contracts signed in 2025. Can you say something about the nature of these contracts? Are these mostly 20 or 15-year contracts? Do you have some figures about that?
Yes. So what we see is that long-term contracts remain the backbone, and the average duration of the contract signed in 2025 was just below 15 years of duration. So this is of course shorter than the 20 years, which was more historically the average for long-term contracts. But still we see that there is a clear appetite for contracts with a rather long duration. As buyers value also supply security.
Okay, and one last question that is also very intense, very intense discussion in Germany and in Europe. You mentioned the phase out of Russian gas, but instead there is there's growing dependence on US LNG, which is under a Trump-led administration not so, not everybody feels safe with this. How do you see this situation of, kind of diversification of risk?
It is a very strange comparison because of many reasons, and of course we are aware of such comparisons being made. Before Russia's invasion of Ukraine, Russia met approximately 40% of Europe's gas demand. Now, the share of US LNG in total European gas demand is significantly lower than that. I think just around 20%. There is also a difference that most of that Russian gas was supplied to the European market by one state-controlled company, and we have seen how strongly was that company controlled by the state during the 2022-23 crisis, by the decisions which have been made by that company. So this is not the case by the companies who are involved in the US LNG business. And we have a variety of companies who are involved. Some of them are US-based companies, but many of them are based here actually in Europe and have a global portfolio of LNG operations. So I would say that the players involved are quite different, and also they are not state-controlled. And I would never compare, and this is a personal view, I would never compare from a geopolitical standpoint Russia and the United States. So those are a couple of thoughts on that topic. As you might find out, I'm not a huge fan of this comparison, and I think that we should also be very appreciative by the flexibility played by US LNG in 2022, which has been instrumental in avoiding a full-blown energy crisis in Europe. I think that this is a bit forgotten in the European discourse, how significant and how important was US LNG to avoid a full-blown energy crisis in Europe.
Yeah, thank you for these clear words. There's another question in the chat regarding another topic. What is the view of the IEA regarding biogases? Will they become a more important role of remain a side issue?
At the agency, we have a low-emission gases work program, which allows us to track the short and medium-term developments related to what we call low-emission gases, including biomethane, hydrogen, and e-methane. And what we very clearly see is that biogas and in that respect, biomethane are the most mature technological option when it comes to low-emission gases. They are also quite more competitive than hydrogen, for instance, in terms of costs. And we start to see it scaling up. I think that most of the growth over the medium term is still expected from Europe, also from North America, from the US. But we also start to see quite some strong cases and ambitions in other emerging markets. Both Brazil and India introduced legislation which provides binding targets for biomethane shares in the gas grid or in the use of transport. So I think that I would not call it as a side issue. I think that there is a huge potential for biomethane. Of course, there are challenges, but I think that with the right policy and regulatory framework and with the right incentives, biogas and biomethane production can become as a more significant part of the global gas supply mix. At the moment, it is just 1% of the total gaseous fuels.
Okay, thank you very much. Yeah, thank you again, Frederick, for these valuable insights into your report. If you made one thing clear, is that the global natural gas market is undergoing a significant structural change with remarkable impacts on both the European and German markets, where natural gas continues to play a key role in the energy mix. Wir sehen, liebe Zuschauerinnen und Zuschauer, dass der globale Markt für Erdgas weiter zusammenwächst und damit auch stärker globalen geopolitischen Entwicklungen unterliegt. Die LNG-Infrastruktur an den Küsten Europas, also auch an den deutschen Nord- und Ostseeküsten, bildet den infrastrukturellen Anschluss an diesen Markt und wird als solche immer wichtiger. Einen ganz herzlichen Dank nochmal an unsere beiden Referenten, Gergely Molnar und Frederik Ritter, für ihre wertvollen Einblicke. Und vielen Dank auch an Sie, liebe Zuschauerinnen und Zuschauer, für Ihr Interesse und Ihre Fragen. Die Präsentation stellen wir Ihnen wie gewohnt im Nachgang zur Verfügung und eine Aufzeichnung des Webinars finden Sie zeitnah auf unserem YouTube-Kanal. Ich wünsche Ihnen noch eine erfolgreiche Restwoche und freue mich, wenn Sie auch bei unserem nächsten Webinar wieder dabei sind und bis dahin auf Wiedersehen.